Hi, I'm Brandon. Welcome to Trading Mindset. Today's video is extra special in that I'm asking you, the viewer, to participate. For some background, this series examines psychological concepts, biases, and fallacies as they relate to trading and investing. Today's topic is sudden death aversion, but before I explain exactly what that is, I want to play a game. This game, or experiment really, comes from a study done by Jesse Walker, Jane Risen, Thomas Gilovich, and Richard Thaler, published in the Journal of Personality and Social Psychology. A link to the full paper can be found in the description below, but let's get started. Hello, today we'll be hosting a game involving a deck of cards. Please utilize the chapters feature at the bottom of this video or in the description to navigate quickly. Now, please welcome this evening's wonderful dealer. Hello, I'll be your dealer today. I'd like to offer you the choice between two different but simple card games. The payout possibilities are identical. If you win, you receive $25. If you lose, only $5. Now, there is a $10 entry fee. Please mail payment to 315 Rockefeller Avenue. Stop it, nobody's sending you money. Here are the rules to game A. I have here a standard deck of cards. I will draw one card from this deck. If it is a face card, so a jack, queen, king, or ace, you win. If I draw anything else, you lose. Here are the rules to game B. I now have two separate decks of cards. I will draw a card from the first deck. If it is an 8 or higher, we will proceed to the second deck. If it is a 7 or lower, you immediately lose. Upon proceeding to the second deck, we will repeat the draw. If you draw an 8 or higher from both decks, you win. Now, which game would you prefer to play? I'll give you a moment to consider your options. Now, if you chose game B, please skip forward to the next video chapter. Are you ready for game A? Let's get started. Oh no! Unfortunately, you'll be walking away with only $5. Thank you for participating. Anyway, let's see how those who chose game B fared today. Are you ready for game B? Let's begin with the first deck. Excellent. Now on to the second deck. Oh no! Unfortunately, you'll be walking away with only $5. Thank you for participating. If you did actually play along, thank you for participating, and I'm curious which game you actually chose. Feel free to leave a comment down below explaining your choice. Before we examine what just happened and apply it to trading, let's break down the probabilities of the card games and the results of the actual experiment. For game A, participants had a simple 31% chance of winning the $25. Participants in game B had a 29% chance of winning, resulting from two independent draws with a 54% chance of success. Therefore, game A provides participants with a slight probabilistic advantage. If you did choose to play game B, you'll be glad to know that you're not alone. In the original experiment, 61% of experiments chose game B as well. So, what's happening here and what can we learn from this? The applicable theory, sudden death aversion, occurs when one is presented with the possibility but not the inevitability of loss. Previous literature finds that if pain is guaranteed, humans will metaphorically rip the band-aid off. When negative experiences are only a probability, like in the card game, humans have a tendency to delay, thus psychologically distancing themselves. In the world of trading and investing, we could see how sudden death aversion could apply to derivatives trading. Options contract prices may not have perfectly predictable probabilities, but the options themselves do have specific dates of expiration. Let's say that a trader is invested in an options contract that's just hours from expiration, with ever decreasing odds of turning a profit. They have the choice to either sell now and limit their loss, or wait a couple hours, delay the loss, and hope the price trend miraculously changes direction. In most cases, it will benefit the trader to simply rip the band-aid off, or in traders' terms, cut their losses, and direct their attention towards a new prospect. But sudden death aversion may just convince you to delay the loss instead. Something that may help you avoid common trading biases and fallacies is exposure in practice, which is why Bybit offers a trading testnet for derivatives and spot trading. You can practice by making risk-free simulated trades. Learn how you react psychologically to changes in price, risk, and sentiment, all without risking any capital. Try it out today on testnet.bybit.com. Thank you very much for watching Trading Mindset. Like the video if you learned something new, subscribe and hit the bell to be notified of new episodes. See y'all next time.